After a strong run from value starting last fall, when the vaccines got approved through April, May, value hit some speed bumps along the road this summer. We saw growth actually outperform value by over 500 basis points in June. And there's been a lot of questions, was that it? Was that the length of the value cycle? And we're very much in the camp that we're still early innings in the value cycle, and it's a tremendous opportunity going on. When you look at valuation dispersion today, we still stand above 3 standard deviations by pretty much any metric. Expensive stocks have kept getting more expensive, and cheap stocks are kind of right within the historical range of cheap stocks. When you look at value cycles historically, they tend to be long in duration, about 60 months on average, and also see substantial outperformance, about 140 percentage points on average. Today, we stand about 12 months into the cycle and about 40% of outperformance, so very healthy, but still long to go. I mentioned that data point of 500 basis points of growth outperformance in the month of June. That's actually not that uncommon in a value cycle. In the internet bubble, coming out of that cycle, in the first 20 months, there were 4 months where growth outperformed value by at least 500 basis points. So there are speed bumps in the road, and it's never a linear path in terms of how the value cycle plays out. But it is very much a longer duration. And when you look at kind of where we are today from a just valuation spread standpoint, that opportunity still remains. Let's say spreads and kind of duration of value cycles are all nice, but at the end of the day, we're investing in companies. And what do you see in the companies that are in that cheapest quintile? And this is where we get really excited. When you look at both the profitability and the growth prospects of stocks that are in that cheapest quintile, it looks quite healthy. The economic recovery that we're seeing is very good for the earnings growth. Management teams have been very proactive in taking the drastic measures necessary to protect their businesses and to make sure their businesses thrive on the other side. And so we think there's very much strong fundamentals underlying some of this valuation dispersion today. So when you take that all together and you look across the world, we're seeing value stocks offering kind of normalized earnings yield in the low teens, and that compares with expensive stocks in the low single digits, the 10-year treasury hovering around 1.5%. And we think this is one of the few pockets where you can find these real expected returns that are quite attractive versus a market or an investment universe where overall yields have been bid up and valuations in many parts of the market are stretched.